Welcome to the research desk. Imagine executing a fundamental analysis on, the most dominant, globally critical technology company in the world.
Right. You verify the underlying business is flawless.
Exactly. You confirm the macro trend driving its adoption is permanent. You acquire the equity, you hold it for 25 years, and, well, you are still down 80% on your initial capital.
Which is a brutal reality.
It is. And that specific scenario materialized for Cisco shareholders after the year 2000. So today we are conducting a rigorous structural briefing on whether the institutional and retail markets are engineering the exact same psychological trap with Palantir.
Yeah, we are analyzing an absolute binary tension here.
Right. Can a company be exactly what its most aggressive bulls claim? A mission-critical artificial intelligence and defense platform, the very bedrock of modern digital warfare, and still operate as a structurally dangerous equity?
Because investors are prepaying a multiple exceeding 100 times earnings for success that is already fully priced in.
Exactly. My designated position for this briefing is that Palantir is fundamentally redefining enterprise and defense software. The depth of its integration into national security and, corporate data infrastructure establishes a monopoly of trust.
Okay, but
And consequently, historical valuation metrics are completely inadequate for assessing its operational dominance, its switching costs, and its future cash flow generation.
I confront that thesis directly by anchoring our analysis in live market mechanics, not technological hypotheticals. We have an immediate, data-driven case study proving this equity does not trade like a mature software stock.
You're referring to the recent volatility sequence.
I am. It trades like a hyper-reactive, late-cycle narrative vehicle. Let us examine the specific mechanics. Palantir posted 70% year-over-year revenue growth in the fourth quarter of 2025.
Which is an exceptional print.
It is. But following that print, the stock surged exactly 12% instantaneously upon the outbreak of the Iran conflict. The market algorithms and retail participants treated that geopolitical escalation as immediate quantitative proof of a military artificial intelligence moat.
Well, because it is proof of the moat.
Right, but yet shortly after that peak, the equity violently dropped exactly 25% when DOGE-related Pentagon budget cuts threatened the government revenue pipeline.
It was a rapid repricing, sure.
A 25% drawdown on federal budget restructuring rumors demonstrates severe structural instability in the capitalization table. My position is unyielding here. Technological truth does not protect equity holders from the mathematical gravity of valuation.
Even if the technology is indispensable?
Yes. Prepaying a 100x plus price to earnings multiple for peak operational execution represents a massive portfolio risk, regardless of the underlying software quality.
To conduct a proper structural briefing, we must first establish the baseline common ground. We have to separate retail enthusiasm and social media noise from institutional reality.
I agree. We need the data.
Delivering a hard, data-driven defense of the underlying business is the required starting point, because Palantir is not a speculative entity. It is not a meme shell without a viable product generating phantom revenues.
No one is arguing it's a shell company.
Right. The 70% year-over-year revenue growth recorded in the fourth quarter of 2025 is a factual, audited metric. When you analyze the income statement, the company exhibits expanding profitability. It sustains high gross margins, hovering consistently in the 80% range.
Which is elite software economics, yes.
Exactly. And it has achieved 4 consecutive quarters of generally accepted accounting principles or GAAP profitability. This is a critical threshold.
Because GAAP accounts for the stock-based compensation.
Yes, it accounts for stock-based comp, which is the primary mechanism software companies use to, frankly, obfuscate their true operating costs. Applying the Damodaran valuation framework, we evaluate the 4 core gravity walls of corporate valuation.
Revenue growth, target operating margins, capital efficiency, and the discount rate.
Right. And 3 of those 4 gravity walls are broadly favorable for Palantir. The business possesses elite revenue growth, exceptional gross margins, and high capital efficiency because, well, software scales without proportionate physical infrastructure costs.
I don't dispute the business quality.
Furthermore, we must clearly define the genuine operational moat. Palantir is not merely distributing commercial off-the-shelf software licenses. It is embedding highly complex proprietary software directly into defense, intelligence, logistics, and operational workflows.
But the price...
In these specific corridors, institutional trust, rigorous security accreditation, and the outright willingness to operate in classified, high-stakes environments matter vastly more than pricing. This integration depth constitutes a structural monopoly in the defense sector.
Look, I acknowledge the underlying business fundamentals without hesitation. The growth velocity is verified. The 80% gross margin profile reflects elite software economics.
Right.
And crossing the threshold into GAAP profitability demonstrates operational discipline. The business is undeniably exceptional. However, exceptional businesses routinely destroy investor capital when the acquisition price disconnects from mathematical reality.
You're pivoting to the multiple.
We must pivot immediately to the central problem, which is the valuation multiple. I define this as the Cisco March 2000 analogy. We have to analyze this historical precedent in full detail.
The hardware comparison.
Yes, because the contemporary market is replicating the exact same psychological and mechanical error with Palantir. Let us examine the mechanics of the Cisco collapse. In March 2000, Cisco briefly became the most valuable company in the world.
At a roughly $500 billion market capitalization.
Right. It crossed the $500 billion threshold. The foundational logic of the institutional market allocating capital at that valuation was perfectly sound. I mean, the internet was a real structural paradigm shift.
The underlying business was real.
Exactly. The underlying business of routing digital data was real. Cisco's dominant role in providing the physical networking infrastructure for global connectivity was an absolute verifiable reality. They were the undisputed toll bridge for the internet.
But the market over-extrapolated.
Yes. The market discounted entirely too much future success into the present equity price. Investors modeled growth rates that were mathematically impossible to sustain as the denominator expanded. The technological truth of the internet revolution did not save Cisco shareholders from the mathematics of overvaluation.
The collapse was historic?
It was an 80+% drop. It went from approximately $80 per share down to $11. And even 25 years later, as a highly profitable, dividend-paying, globally dominant enterprise, the equity has never recovered its peak valuation from the year 2000.
So you see Palantir facing the same fate?
My structural thesis is that even if Palantir's artificial intelligence moat proves entirely durable, prepaying a 100x plus price-to-earnings multiple guarantees terrible future returns if execution falters by even a single basis point. Or, if the broader macroeconomic environment demands a higher equity risk premium.
The Cisco analogy is powerful, but it requires context that fundamentally separates hardware infrastructure from an artificial intelligence operating system. Cisco sold physical boxes into a market that eventually commoditized.
Infrastructure is infrastructure.
No. We must transition to the foundational artificial intelligence operating layer to understand why the 100x multiple is being underwritten by institutional capital. Palantir is not merely an AI company participating in a cyclical hype cycle.
Then what is it?
It is actively architecting the operating layer through which artificial intelligence is deployed in high-stakes environments. The pillars of institutional adoption completely validate this premise. The 70% year-over-year revenue growth overall is driven by expanding, indispensable utility.
Driven largely by defense, though.
Not entirely. More critically, we must explicitly cite the commercial business segment. Palantir's commercial business grew 45% year-over-year in the fourth quarter of 2023.
Okay, 45% is strong.
That specific metric permanently disproves the persistent bearish myth that Palantir is merely a low-margin, bespoke government contractor masquerading as a high-multiple software vendor. When you couple 45% commercial growth with 80% gross margins, the financial architecture reflects elite, highly scalable software economics.
But the valuation is still pricing in perfection.
Because Palantir is striving to be the Windows of operational AI, it is positioning itself as the central nervous system for institutions that simply cannot afford failure. It is the connective tissue between disparate data silos and actionable, automated decision-making.
That is a very aggressive narrative to underwrite.
To fully understand the durability of this position, we must comprehensively narrate the Project Maven episode of 2017.
Oh yes, the Project Maven operational history is essential for understanding the cultural divide in Silicon Valley. Detail the specifics of that procurement cycle.
In 2017, the United States Department of Defense launched Project Maven. The core objective was to apply artificial intelligence and machine learning to massive volumes of drone footage, aiming to automate the identification of hostile targets, civilian infrastructure, and operational assets.
The military was essentially drowning in sensor data.
Exactly. They lacked the human analyst capacity to process it. Initially, Google participated in this initiative, viewing it as a standard enterprise application of their advanced computer vision models. However, severe internal employee protests erupted within Google regarding the weaponization of artificial intelligence.
Right, the engineers pushed back.
Thousands of engineers refused to build software designated for targeting purposes. Consequently, yielding to internal political pressure, Google formally withdrew from the defense contract. Palantir immediately stepped into that exact vacuum.
Taking over the entire operational mandate?
Yes, and this event established their cultural moat, which is just as vital as their technological moat. The willingness to serve national security use cases without equivocation, without internal political friction, and with absolute operational secrecy is a tangible, highly monetizable asset.
I agree the cultural moat exists.
Because of this deeply embedded cultural alignment, we must analyze the current DOGE efficiency pressures. The Department of Government Efficiency mandate requires the federal government to aggressively reduce headcount and operate with severe austerity.
Which sparked the 25% drawdown we discussed.
But that drawdown was a misinterpretation. When personnel budgets are slashed, human analysts are terminated. Automation, artificial intelligence, and centralized software platforms become the only viable mechanisms to maintain operational readiness.
So you're saying the cuts help them?
Precisely. Doing more with less actually accelerates Palantir's structural moat. It forces legacy agencies to adopt the central nervous system out of sheer operational necessity.
The assertion that strategic importance automatically translates into intrinsic equity value is a categorical error in financial modeling.
How so?
Being an indispensable vendor to the Department of Defense does not mathematically mean the equity asset is undervalued. We must aggressively push back on the mathematics required to justify a 100x plus forward earnings multiple.
The growth supports the multiple.
Does it? For the current valuation to hold without generating negative returns for the investor, the mathematical model requires Palantir to sustain 50+% revenue growth for 5 or more consecutive years.
Which they are currently exceeding.
Currently, yes. But it also requires unbroken linear margin expansion. It requires an absolute limitation on shareholder dilution, meaning stock-based compensation cannot dilute earnings per share faster than net income grows.
They've achieved GAAP profitability.
True, but furthermore, it demands that the bespoke, highly customized commercial integration business magically transforms into frictionless, repeatable annual recurring revenue. Financial history dictates that almost no enterprise software company manages all 4 of those variables flawlessly over a half-decade horizon.
It's rare, but not impossible.
To reinforce this reality, we must look beyond Cisco to a much harsher historical warning regarding critical infrastructure. I'm talking about Exodus Communications.
The data center company?
Yes. Exodus was the premier backbone-era infrastructure darling of the late 1990s. It housed the physical servers and data centers for the entire internet revolution. It was arguably the most critical operational vendor for early .com enterprises.
But it was a hardware play.
In early 2000, equity peaked above $100 per share. By late 2001, it traded for pennies and formally filed for bankruptcy. It provided absolutely critical infrastructure, yet it resulted in a total loss of capital for late-stage investors.
The comparison to Exodus Communications contains a fundamental structural flaw. It assumes Palantir's technology will follow the exact same commoditization curve as physical server space.
The cycle of hardware and software commoditization often rhymes.
But Exodus provided a highly capital-intensive physical hosting service. Once bandwidth and server manufacturing scaled, the margins collapsed.
Palantir operates on an entirely different economic physics.
Explain the physics then.
Palantir constructs a data ontology. An ontology is essentially a universal translation layer. It maps disparate data inputs like satellite imagery, supply chain logistics, human intelligence reports into a single cohesive operational reality.
Right. A unified data model.
This ontology creates exponential value the longer it remains embedded. It becomes smarter, more integrated, and more essential every single day it operates. This fundamentally differs from the static physical server hosting model of Exodus, which had zero network effects or compound learning advantages.
The core issue we are evaluating is not just the durability of the software, but the phenomenon of narrative stacking.
Narrative stacking?
Yes. Narrative stacking is a classic, highly dangerous, late-cycle behavioral phenomenon in equity markets. We are witnessing an equity price supported by too many simultaneous, disjointed reasons for ownership.
The catalysts are legitimate.
But bulls are stacking the military artificial intelligence moat, the DOGE efficiency mandate, the artificial intelligence platform enterprise adoption curve, a perceived global data monopoly, and the immediate catalyst of the Iran conflict into a single, unified valuation thesis.
Because they are all happening simultaneously.
This is mathematically highly unstable. If any single pillar of that narrative stack falters, say if commercial adoption slows by 5%, or if the defense budget prioritizes kinetic weapons over software upgrades, the multiple compresses violently.
The fundamentals would cushion the blow.
I disagree. When we contrast the heavy, continuous insider selling against retail enthusiasm and the relentless launch of Palantir heavy exchange-traded funds, we see a dangerous market structure.
Passive flows are a reality of modern markets.
But we are witnessing artificial passive flow support rather than fundamental intrinsic price discovery. Passive ETFs are blindly purchasing shares regardless of valuation, absorbing the liquidity that insiders are actively distributing.
We must dissect the specific mechanics of the operational moat to correct that perspective regarding narrative fragility. The depth of Palantir's integration actively negates the risk of sudden multiple collapse.
I don't see how integration negates valuation risk.
Because replacing Palantir in a military or intelligence context is operationally dangerous. It is not simply a matter of budget allocation or procurement cycles. It is a matter of national security continuity.
The switching costs are high, yes.
Comparing Palantir to standard enterprise software is factually incorrect and leads to flawed valuation models. Palantir operates as a mission-critical flight control system. If you remove the flight control system midair, the aircraft crashes.
That assumes the aircraft is flying smoothly to begin with.
It is not a widely adopted commercial operating system like Microsoft Office or a basic customer relationship management tool where switching costs are measured in mere productivity delays, temporary revenue dips, or IT retraining budgets.
Fair point on the IT budgets.
The switching costs for Palantir in the defense sector are measured in battlefield casualties, catastrophic intelligence failures, and compromised operational security. When an asset becomes the literal nervous system of the defense apparatus, the revenue stream transcends typical software churn rates. It becomes a permanent line item.
I mean, the flight control system analogy is highly compelling, but it assumes the aircraft itself is fully functional and capable of achieving maximum velocity. I counter that analogy with the concept of a Ferrari on unpaved roads.
Unpaved roads?
Yes. Palantir's artificial intelligence platform, or AIP, may indeed represent absolute elite software engineering. It may be the literal Ferrari of enterprise artificial intelligence. However, legacy enterprise environments, and most notably federal government agencies, run on profoundly fragmented databases.
Which Palantir fixes.
Eventually, but they face severe security clearance restrictions and glacial, highly politicized bureaucratic processes. The operational roads are entirely unpaved. The reality of the Department of Defense limits the speed at which the Ferrari can actually drive.
Integration takes time, certainly.
You cannot execute split-second automated target acquisition if the underlying data architecture requires a human clerk to manually verify security clearances across disjointed networks. Therefore, the total addressable market for frictionless, instantaneous deployment is vastly smaller than the bullish models suggest.
So you question the speed of scale.
Exactly. This brings us to the ultimate wildcard of this entire analysis, which institutional capital must scrutinize: the actual form of the revenue. Is this revenue generated from bespoke deployment requiring high-touch, human-intensive, consulting-like engineering labor to pave those dirt roads?
Or is it pure software?
Right. Or is it truly repeatable software revenue characterized by lower friction, zero marginal cost deployment, and standard software as a service annual recurring revenue metrics? If it is the former, a 100x multiple is a mathematical absurdity.
To address the revenue form and the unpaved roads analogy, we must rely on historical procurement context. The United States Department of Defense has struggled for decades to unify over 2,000 disparate, deeply entrenched IT systems.
2,000 systems is a massive administrative burden.
It is. These fragmented networks created dangerous intelligence silos where the Navy could not share real-time sensor data with the Air Force without extreme latency. The difficulty of creating standardized, interoperable systems across different security classification levels was practically immense.
And Palantir is the solution?
Palantir is the specific entity successfully unifying this chaos through its proprietary ontology mapping. They are the ones paving the road. Once a system achieves that unification, the mode of inertia takes over.
Inertia is a powerful force in government. I'll give you that.
Exactly. Disentangling 2,000 unified systems after they have been synchronized is exponentially harder and more expensive than integrating them in the first place. The revenue form absolutely begins as high-touch, human-intensive deployment out of sheer necessity, because legacy architecture requires manual mapping.
So it starts as consulting.
But it rapidly transitions into highly defensive, pure-margin recurring software revenue because the cost, the time, and the operational peril of extraction become totally prohibitive. Once the ontology is set, subsequent modules deploy with standard software friction.
We now move to the synthesis of this briefing and the explicit portfolio recommendations required for institutional risk management.
The actionable strategies.
Yes, the analytical framework required here is the narrative cycle versus the gravity wall. The narrative side of Palantir is completely saturated. Every possible bullish catalyst, artificial intelligence dominance, geopolitical instability, efficiency mandates, is already known, heavily debated, and fully priced in by both the retail and institutional markets.
You believe there's no information edge left?
There is no hidden bullish information edge remaining. The gravity side of the valuation framework is decidedly mixed. The growth velocity and margin metrics are flashing bright green. However, the valuation multiple and the discount rate sensitivity are flashing deep red.
Highly sensitive to interest rates.
Any minor expansion in macro treasury yields or a single missed quarterly earnings metric will trigger severe, immediate multiple compression. We will now execute a rigorous, direct walkthrough of the 7 specific portfolio recommendations derived from this analysis.
Recommendation 1. Respect the business but trim the multiple. Institutions must strictly cap direct equity exposure at exactly 1 to 2% of the total portfolio allocation unless the stock materially re-rates to a lower valuation multiple.
That's a prudent cap.
You absolutely do not underwrite a business at a 100x plus price-to-earnings ratio as if the fundamental mechanics of valuation no longer apply. A 1 to 2% allocation allows participation in the upside if the artificial intelligence monopoly thesis fully materializes, while strictly containing the drawdown risk if the multiple compresses toward historical software averages.
Recommendation 2. Wait for a skeptic's entry zone. The precise target parameter for aggressive capital deployment is a 40 to 60x price-to-earnings range.
That requires a significant pullback.
It does. This strict parameter assumes that current revenue growth velocity and gross margins hold steady at their current elite levels. Purchasing the equity above the 60x band offers absolutely zero margin of safety for the investor. It demands absolute perfection from the management team and the macroeconomic environment.
Recommendation 3. Use options for tactical bearishness. For portfolio managers requiring a defined hedge against the current valuation extremity, utilize put options struck exactly 15% below the current market price with a 9-month expiry.
The 9-month window is key.
Yes, this position must be strictly sized at roughly 2% of total portfolio risk. The 9-month duration is highly specific. It ensures coverage across 3 complete quarterly earning cycles, providing sufficient time duration for narrative exhaustion to materialize and for the market to demand fundamental cash flow justification over artificial intelligence sentiment.
Recommendation 4. Monitor commercial quality strictly. The top-line commercial revenue growth must remain consistently above the 30% year-over-year threshold.
Because commercial is the growth engine.
Exactly. A deceleration below this 30% mark indicates the artificial intelligence platform enterprise adoption curve is stalling out. More concerningly, it suggests the business model is reverting to bespoke, unscalable consulting engagements rather than frictionless software distribution. The commercial growth metric is the definitive proof of concept for the terminal valuation.
Recommendation 5. Separate DOGE risk from standard government procurement volatility. You must monitor government contract value and bookings with extreme precision.
Looking for actual cancellations.
Right. A greater than 10% year-over-year decline in total government contract value or bookings for 2 consecutive quarters serves as a severe structural warning signal. It indicates that federal efficiency mandates are resulting in outright budget destruction and cancellations, rather than driving software consolidation and automation upgrades.
Recommendation 6. Treat war-driven rallies as narrative tests, not long-term thesis confirmations. We must reiterate the live market case study presented at the beginning of this briefing.
The Iran reaction?
Yes, the exact 12% equity surge on the outbreak of the Iran conflict confirms that algorithmic trading models and quantitative funds view Palantir purely as a high-baited defense and artificial intelligence proxy.
A tactical trade, not an investment.
It does not prove intrinsic cash flow value, and it certainly does not guarantee long-term free cash flow generation. Geopolitical spikes are liquidity events, not permanent valuation floorings.
Recommendation 7. Watch the equity flow mechanics closely. Institutional strategists must continuously monitor the velocity of insider selling against the capital inflows from Palantir-heavy exchange-traded funds.
The passive bid.
Exactly. A sustained divergence where corporate insiders aggressively distribute their shares directly into the passive bid of retail-driven ETFs is the definitive textbook signature of a late-stage narrative cycle. When the architects of the technology are monetizing their equity while retail capital blindly accumulates it regardless of price, structural risk is at its absolute maximum.
We arrive at the bottom line of the structural briefing. We completely concur on the operational reality and the technological superiority of the asset.
The fundamentals are solid.
Unquestionably. Palantir's government and defense embed is vastly more defensible, deeply integrated, and operationally sticky than Cisco's hardware dominance ever was in the year 2000. Hardware inevitably commoditizes faster than a highly classified, heavily integrated software data ontology.
But the valuation remains the hazard. Precisely.
Financial markets possess the capacity to correctly identify the technological future and still wildly, destructively overpay for it in the present.
To conclude our analysis, we rely on the specific assessment from the underlying research text. Palantir may well become foundational AI infrastructure. That still does not make 100x plus earnings safe. For now, the most intelligent posture is simple. Admire the moat, scrutinize the revenue quality, and refuse to confuse strategic importance with a margin of safety.
This is the research desk officially signing off.